Good day, everyone. I am Jamaica Andangan from Group 5. So today we will be discussing about a central banking authority. So what is central banking authority? Central banking authority is like the main bank of the country that manages its money and financial system. It controls how much money is in circulation, set interest rates, and ensures that other banks follow the rules. So unya my co-group mates will discuss further kung unsa gid ang naa sa Central Banking Authority. So now let's proceed to the subtopics. So the first subtopics is the monetary board. Next is the board membership evaluation. Next is the powers and duties of the governor or present officers. And the next is the domestic monetary policy. And lastly is the international monetary stability. So now let's proceed to the first subtopics, which is the monetary board.
Monetary Board is a type of monetary authority responsible for managing a country currency and maintaining a fixed exchange rate with a foreign currency. So meaning to say is ang monetary board ako is ga-represent siya sa usa ka talagsaon nga pamaagi sa pagdumala sa salapi sa usa ka nasod. So there are four various responsibility of monetary board. So first is we have our price stability, second is a monetary policy decision, and the third is financial stability, and the last is crisis management. So first is we have the price stability is means that the general price level of goods and services in an economy so remains relatively stable over time. So just like for example, kung ang usa ka nasod diin ang mga ang mga presyo kanunay nga nagsaka og 5% every year or matag tuig, kini is mahimong isipon nga mas taas og dili mahibaw-an ang inflation. The second is monetary policy decision. So, ang monetary policy decision is managing the economy and achieving macroeconomic objectives. So, the third is financial stability. So, the financial stability is the ability of banks, financial institution, and market to operate effectively and avoid systematic crisis. So the last is crisis management. So the crisis management is the process of preparing for responding to an recovering the crisis that threaten an organization or system. So
Board Membership Evaluation. The Board Membership Evaluation is a structured process used by organizations to assess the effectiveness, performance, and dynamics of their board directors. The key aspects of a board evaluations typically include: first is performance review. This involves a detailed assessment of how effectively the boards fulfill its central duties. The evaluation often reviews how the board's decisions have aligned with the organization's goals and objectives, how effectively the board responds to crisis, and its role in major organizational achievements or failures. Next is composition and diversity. This diversity enhances the board's ability to approach problems from multiple angles and to innovate. Evaluations may include assessment of how board members' individual strengths contribute to the whole and whether there are gaps in skills or perspective that need to be filled. Third is board processes and procedures. This section scrutinizes the structures and process the board uses to operate. It looks at the frequency and duration of board meetings, the preparation and distribution of meetings materials, decision-making mechanism, and the effectiveness of committees within the board. Fourth is board dynamics and relationships. The interpersonal and professional dynamics between board members as well as between the board and management are critical for effective governance. This part of evaluation examines whether board discussions are characterized by openness and respect, whether dissent is handled constructively, and how conflicts are resolved. The fifth is compliance and governance. This area reviews the board's adherence to legal and regulatory requirements, as well as its commitment to best practice in corporate governance. Compliance is non-negotiable, and boards must ensure they are up to date with changes in the law and industry standards. And the last one is development and training. Board evaluations often identify needs for ongoing education and professional development. This can include training in specific areas such as financial literacy, legal responsibilities, or emerging industry trends relevant to the organization's operations. The aim is to continuously enhance the board's capabilities and effectiveness through targeted training programs and resources, ensuring that all board members are equipped to provide high quality governance.
Powers and duties of the governor or present officer. So the governor is the chief executive officer of the BSP or Bangko Sentral ng Pilipinas. So the governor is responsible for overseeing the implementation of the policies set by the monetary board. So, the governor is pinaka-head na siya sa Bangko Sentral ng Pilipinas or BSP. So, responsible siya for making sure that the kanang policies nga gina-create sa monetary board are put into actions. So, this means that the governor ensures the BSP runs smoothly and achieves its goals. The following duties of the governor or the main responsibilities of the governor are policy implementation, financial market oversight, and coordination with government. The governor makes sure that the decisions made by the monetary board are carried out properly. This means making sure that the kanang mga rules about money supply, interest rates, and the banking system are followed. And also, the governor watches over the country's financial markets like banks and financial institutions to make sure they are running smoothly and safely. So this helps para ma-prevent ang financial problems or crises. And lastly, the governor works with other government agencies to make sure the country's economic policies such as giunsa sa government pag-spend ang money o pag-collect sa tax para mag-match siya sa BSP's monetary policy. So this ensures the country's overall financial system stays stable. The current governor is Eli Remolona. So Eli Remolona is an experienced economist who has worked with global financial institutions like the Bank for International Settlement. So his experience helps him make informed decisions that benefit the country's economy.
So hello everyone, good day. So my topic assigned is domestic monetary policy. So what is domestic monetary policy all about? So domestic monetary policy is refers to the actions a country's central banks or monetary authority takes to manage the economy by influencing factors such as inflation, employment, and economic growth. So these policies primarily involve the regulations of the money supply and interest rates to achieve specific economic goals. So there are the primary tools used by central banks. Number one is interest rates, number two is open market operations, and number three is reserve requirements. So number one is interest rates. So central banks can raise or lower interest rates to influence borrowing costs and encourage or discourage spending. Higher interest rates tend to slow down economic activity, while lower interest rates can stimulate growth. So number two is market operations. So this involves the buying and selling of government securities by the central bank in the open market. By purchasing by purchasing securities, the central bank can inject money into the economy, while selling securities can reduce the money supply. So the last one is reserve requirements. So central banks can set the minimum amount of reserves that commercial banks must hold against their deposit. By adjusting reserve requirements, the central bank can influence the amount of money available for lending. So it is important to note that domestic monetary policy can be influenced by internal factors such as international trade, capital flows, and global economic conditions. So central banks often need to coordinate their money their monetary policies with other countries to ensure stability in the global financial system. So that's all for thank you.
Let's break down international monetary stability in easy to understand parts. So, what is international monetary stability? Imagine in the world's economy as a big marketplace where countries buy and sell goods and services. For this marketplace, for this marketplace to work well, the money used by each countries needs to be relatively stable and balanced. That's what international monetary stability is all about. So, why does it matter? Stable currencies, imagine you want to buy something from a friend in another country. If the value of their money changes a lot compared to yours, it becomes difficult to know how much you're actually paying. Stable currencies make trade is easier because everyone everyone knows how much things cost. So, low inflation. Inflation is like prices going up quickly, making things more expensive. Stable currencies help keep inflation under control so everyone can afford things. So, stable interest rates. Interest rates are like the cost of borrowing money. Stable interest rates help business make plan and manage their finances, leading to more economic growth. So let's proceed. Factors affecting stability. So let's proceed to exchange rate. Exchange rate. Think of exchange rate like the price of the currency compared to another. If the price changes too much, it makes trade unpredictable. Stable exchange rate make it easier for business to plan and invest. So inflation. High inflation means that the value of your money goes down over time. Countries with stable inflation can keep their money valuable and predictable. So interest rates. Central banks like Federal Reserves in the US use interest rates to control inflation and the economy. So consistent interest rate help keep the economy stable and prevent big problems. Global cooperation. International organizations like the IMF, the organizations help countries work together to keep the world's economy stable by giving advice, loans, and monitor global financial system. Trade agreements. Countries also make agreements to trade with each other, which help to keep their currencies balanced. The importance of stability. International monetary stability is like a set of rules that keeps the global economy running smoothly. It helps countries trade with each other, invest in each other, and grow their economies. Thank you. So, in conclusion, central banking authorities are vital for economic stability and growth. By managing interest rates, money supply, regulatory policies, they control inflation, support employment, and respond to financial challenges. Their rule extends globally as they balance domestic needs with international stability, helping ensure resilient economies and smooth financial interactions worldwide. Again, we are from Group 5, and that would be all. Thank you.